All right. Welcome to our YouTube Live. Good to be with you today, and wanted to start off by trying not to get overly large here. I am going to do this so I'm looking at you and not at myself on the screen. So I'm going to start off by just sharing our 5 investment themes for the year and what we think that means to you. Number 1 is that the theme of U.S. investment. Because of reshoring, because of AI, because of global tensions which spark security concerns, cybersecurity, as well as physical security, and power infrastructure that's going to be needed. Number 1, just with our growing population, and number 2, with the increase in the advent of so many more electrical vehicles. We're seeing brownouts and blackouts not only in California but across Europe, and we think that bodes well for power infrastructure companies. The second theme is moderating equity valuations. So when you think about the way markets trade, you have a company, and let's say it has $1 of earnings per year, and it trades at 30 times earnings. That stock is at $30 a share. And so we believe that because of the solid fundamentals of the U.S. economy, we will see earnings continue to grow for many companies, but it's difficult to see those valuations increasing. So if you have a multiple that comes from 30 down to 25, and yet the company's earnings grow 10%, you could have slow or no growth in or negative growth in the price of that stock. So even in an improving economy for earnings, it's going to be difficult to get multiple expansion. But a mitigating factor to that is, I think we'll see one of our other trends, which is evolving market leadership. So we have had the worst breadth in the market we have seen in decades. So 8 of the last 9 years, in fact, more than half of the S&P 500 companies have underperformed the index. So what you're not seeing is sort of an equal distribution. You're seeing the largest companies performing well and the smallest companies really sucking wind. And so, in fact, if you look at the 10 largest companies in the S&P 500, they're trading at double the valuation of the smallest 100 companies. In fact, the smallest 100 are trading at about 50% of the valuation of those large companies. So we think that will change. You may see a lack of expansion in multiples in the big companies, and you may see an expansion of the multiples in those smaller companies. And so that's just kind of plays into that theme that the winners of the last cycle are not likely to be winners of this cycle, and that instead of skating to the puck, we need to skate to where the puck's going, or go fishing in new fishing holes, as they'd say where I grew up. Another theme is the U.S. has a solid economic foundation, whether you look at consumer balance sheets or labor markets, corporate profits, business investment indicators. Those are all really positive. The mitigating force against that is that the fiscal sustainability of spending at the government level is going to present some real headwinds. I know there have been a lot of things in the news lately about misuse of federal dollars, and we're not talking about any kind of political issue here. We're talking about a fiscal issue, that the amount of spending relative to tax revenues is not really sustainable. So something will have to give on one side or the other, or both sides of the ledger, the income or the outgo. So those are the factors that we see at play here. And so we are putting that to work in our portfolios. Now, the name of this session isn't Ask Me Anything, so we'll go to some questions. So one question that we got was, what's the proper order of operations for savings? Which is a great question as we get started. The number one most important factor and most overlooked factor is having that emergency fund, that slush fund, the rainy day fund, whatever you want to call that, but having that financial shock absorber so that you have the liquidity to take care of life when it shows up, and it inevitably will. The unexpected occurs with such regularity that we should go ahead and expect it. So number one, having that emergency fund available. Number two, getting started on investing for long term. And then number three, all the other things come involved there. So we've got some blogs on our website that dive into that deeper if you want to know more. And so I'm looking here at some questions. All right. One is also, how do I know if I can retire? Do I have enough? And we have a blog on our website that specifically addresses that to give you a really clear way of determining, number one, what is your burn rate? How much are you actually spending on a monthly or annual basis? And what does that nest egg need to look like so that you can back into your number and say, okay, here's where I need to be, and am I above that, or am I below that, or am I on track to get there in my time frame? All right, and so how do I get started? The easy way to get started is to set a target on your emergency fund and get that built up so that you have, depending on the stability of your cash flow, 3 to 12 months of expenses there so that when life shows up, you can handle those things. Another question showed up is, how do I know what to invest in? Well, that is an evolving question. So the answer today is not necessarily the same, and in fact is different than it was in March of 2009 as we're coming out of recession. That's a different answer than it was in March of 2000, which is a different answer than it was in January of 2004. So my recommendation, just like it would be if you asked me health advice, is go to a professional and see, based on your situation, where should you be. We think stocks still look attractive on a very selective basis in the US and internationally, and bonds, which we railed against, traditional bonds for years, actually are looking like a reasonable bet for people who need a lower risk and need income. I do think that that old 60/40 portfolio that so many people relied on is a way to manage risk from the last few decades. I think we're in a situation now there technology has allowed us to mitigate risk in different ways. And so again, those are factors that it makes sense to talk to a qualified professional, somebody that you trust, to get insights on what to do now. All right, I'm looking here to see some other questions. Do I start with retirement for myself or education for my kids? That is really going to boil down to your priorities. Some people would say, always start with taking care of yourself first. And there is some wisdom in that. But I think this really goes to what's important to you. And hopefully it's not an either or decision. Hopefully you're in a place where you can do both. And the important thing is to get clarity, to get absolute clarity over what's important to you. And when your priorities are clear, your decisions are easy. It's the lack of clarity that makes that question difficult. But when your priorities are clear, when your values are clear, your decisions are easy. And so I will say we have some clients where we have focused on their children's education at the expense of their own retirement planning intentionally, because that's what was important to them. There are the majority where we focused on their retirement and simultaneously did some investing for the education of their kids. One way to think about that in an important frame is that having a nest egg to last from the time you stop working for the rest of your life or the time you begin working or begin work optional phase of your life, that's likely to last a whole lot longer and be a whole lot more expensive than educating your children. All right. We, in order to honor everybody's time, we'll take one more question and then we'll wrap it up. If you're a client, you're probably not logged into this because you can ask me anything anytime it's convenient for you. So this is really to open things up for other folks. And the other question, of course, is, should I pay off my house? And that again becomes a very personalized question. And if your mortgage rate is 7%, that becomes a different calculation than if your mortgage rate is 3%. And also your time frame and what else is going on in your life. Last question is Bitcoin a risky investment? Bitcoin is a very volatile investment. And so yes, the risk on it is very high. Anybody who purchased Bitcoin 6 months ago has experienced that risk. If they bought it, they've experienced the downside risk. If they bought it 2 years ago, they've experienced the upside and then seen some of their profits evaporate. So it is volatile and is likely to remain volatile. If you'd like to know if that makes sense for you or what is a good way to get some exposure there, you can give us a call or talk to a qualified professional. Thanks for joining us today. I'm Greg Lukin. All the best.